For a long time, economic uncertainty was treated as a temporary disruption. Businesses assumed that volatility would fade, conditions would stabilize, and familiar growth patterns would return. Strategic plans were built around that expectation. In 2026, that assumption is gone. After years of persistent uncertainty, U.S. businesses are no longer waiting for a return to normal. They are building a new playbook designed for an environment where instability is not an exception, but the baseline. This new business playbook is not driven by panic or pessimism, it is driven by realism. Leaders have accepted that interest rates may remain elevated, demand may fluctuate unpredictably, supply chains may face recurring stress, and regulatory conditions may evolve without long lead times. Instead of fighting this reality, companies are redesigning how they plan, invest, operate, and measure success. One of the most fundamental changes is how businesses approach planning. The old model relied heavily on single forecasts and long-term projections built around narrow assumptions. Today, that approach is seen as fragile. Companies are shifting towards scenario-based planning, where multiple futures are considered at the same time. Rather than asking which outcome is most likely, leaders ask how the business performs across a range of plausible outcomes. This changes how decisions are made and reduces the risk of being blindsided. Capital allocation has been deeply affected by this shift. In the past, excess capital was quickly deployed toward expansion, acquisitions, or ambitious new initiatives. Under prolonged uncertainty, capital is treated more cautiously. Businesses are prioritizing optionality, investments are staged, milestones matter, and irreversible commitments are scrutinized closely. The goal is not to avoid investing, but to invest in ways that preserve flexibility if conditions change. Financial discipline sits at the center of the new playbook. Strong balance sheets, healthy cash reserves, and manageable debt levels are no longer defensive choices. They are strategic assets. Companies want the ability to absorb shocks without immediate layoffs, asset sales, or emergency fundraising. Liquidity buys time, and time allows better decisions. Growth that undermines financial resilience is increasingly viewed as irresponsible rather than bold. Cost structures are being redesigned to reflect this reality. Businesses are moving away from rigid models that require constant growth to remain viable. Fixed costs are being reduced where possible, and variable cost flexibility is prioritized. This includes more cautious real estate commitments, scalable technology infrastructure, and flexible vendor arrangements. The objective is to ensure the business can slow down without breaking. Hiring strategies reveal how deeply this shift runs. Instead of hiring ahead of anticipated growth, companies are aligning headcount with proven demand. Roles are more clearly defined, productivity expectations are higher, and teams are built to operate efficiently rather than expansively. This reduces the likelihood of disruptive layoffs and helps maintain organizational stability even when growth slows. Customer strategy has also evolved. In uncertain environments, reliable revenue matters more than rapid expansion. Businesses are investing more in existing customers, service quality, and long-term relationships. Retention, trust, and lifetime value are prioritized over aggressive acquisition. This creates steadier cash flow and reduces dependence on volatile marketing channels. Product development has slowed in pace but improved in focus. The new playbook favors durability over novelty. Instead of constant feature launches, companies are emphasizing reliability, usability, and incremental improvement. Products are designed to perform consistently over time rather than peak quickly and fade. This supports customer loyalty and reduces operational strain. Technology investment remains a priority, but it is approached differently. AI, automation, and digital tools are still central to competitiveness, but spending is paced more carefully. Investments are tied to clear use cases, phased deployment, and measurable outcomes. Technology is treated as infrastructure that strengthens the core business, not as a shortcut to growth in uncertain markets. Supply chain strategy has been fundamentally rewritten. Efficiency alone is no longer the goal. Reliability and resilience have become equally important. Companies are diversifying suppliers, holding strategic inventory, and building redundancy into logistics networks. These choices may increase short-term costs, but they reduce the risk of catastrophic disruption that can derail the entire business. Risk management has moved from the margins to the center of strategy. Businesses are no longer treating risk as a checklist or compliance exercise. They are actively monitoring operational, financial, regulatory, and geopolitical risks in real time. Scenario planning, stress testing, and early warning indicators are now common tools. Preparedness replaces prediction as the primary objective. Leadership behavior has changed alongside these structural shifts. Executives are rewarded less for bold promises and more for consistency and credibility. Transparency has increased. Leaders are more willing to acknowledge uncertainty and explain trade-offs rather than project false confidence. This builds trust with employees, investors, and partners, which is especially valuable in unstable environments. Investor communication reflects this new mindset. Instead of emphasizing aggressive growth targets, companies highlight earnings quality, cash flow durability, and disciplined capital allocation. Many investors have become more receptive to this approach after years of volatility. Predictability and resilience are increasingly rewarded. Organizational culture is adapting as well. Teams are encouraged to think in terms of trade-offs, not absolutes. Speed is balanced with stability. Innovation is balanced with execution. Success is measured by sustainability rather than spectacle. This cultural shift supports better decision-making across the organization. Importantly, the new playbook does not reject growth, it reframes it. Growth is no longer defined by how fast a company can expand during favorable conditions. It is defined by how consistently a company can move forward across mixed or difficult conditions. Durable growth replaces explosive growth as the primary objective. This shift also changes how success is judged. Companies are evaluated not just by quarterly results, but by their ability to adapt without panic, invest without overextending, and operate without constant restructuring. Longevity, resilience, and trust become central performance indicators. The new business playbook emerging from prolonged economic uncertainty reflects a more mature phase of U.S. business strategy. Leaders are no longer designing companies for ideal conditions. They are designing them for reality, a reality where volatility is persistent, capital is selective, and mistakes are costly.